So I think crypto gave us the signal that things are changing at the margin, but it's too soon for it to fully drive prices. So I think I was just with an interview with Mark Yusko. He put it really nicely. He goes, crypto winter finished in June 14th and crypto spring started, and spring is muddy, some days cold, some days sunny, some days wet, some days windy. But what follows spring is summer, and we're still in spring. So the market goes up and down, doesn't really do a lot, doesn't feel good for anybody, neither bulls nor bears. And that is the function of the economic cycle starting to turn. We're seeing more frequent data on employment suggests that it's weakening fast. We've seen the housing sector weakening fast. We've seen construction, which is a huge employer, weakening fast. We've seen the economic data weakening fast. So at all levels, I think this is still backward looking, and we might still face the same with the inflation numbers that we've got next week, where, I think the Cleveland Fed numbers are looking like they're still going to be strong. So it takes a while for this stuff to come through. Don't forget, we only get one piece of economic data a month, while we get, daily data on every chart, or hourly data, or tick by tick data, depending how much of a degen you are. Here we get one piece of data. So a piece of data is not trend. A piece of data isn't news. You need to take it in context with everything else. In context with everything else, I think that the data is slowing down, and that over time we'll see these employment numbers change as well, because we're seeing everybody laying off staff. I mean, everywhere. And the lesson I learned from many of these is they can remain at a discount for a long period of time, and it could go further. So, could it trade at a 50% discount? It's possible. So if you are sophisticated and you want to make a bet on that gap closing, whether it's via an ETF or some other mechanism like a bull market coming back and people using GPC Trust, go for it. It's not my preferred avenue, but I understand why people might look at it, much like they'll look at futures when they trade cheap as well. It could give you a bit of extra juice. I wouldn't put your granny's life savings into it. Yes, they were imperfect because there was no rules allowing for an ETF, but there's no real reason why they shouldn't. And what you're actually doing is hurting retail investors, and it's just not fair. It's not right. Think of the bullshit that gets ETF nowadays. 100x leverage crap, short stuff, the inverse Kramer ETF.
Yeah.
I mean, this stuff is toxic waste. And yet the Bitcoin one, they don't allow that. I mean, that's stupid. And you've got a lot of retail investors, a lot of RAAs. It was the only avenue you gave them, and you're purposely screwing them over. It's unforgivable. So I think people get confused with what crypto is a hedge against. It's not a hedge against US dollars, because US dollar is the denominator of which most Bitcoin activity changes. Yes, you can trade ETH Bitcoin, but generally speaking, we quote a price and it's in US dollars. So if the dollar goes up, then the price of Bitcoin goes down. It's a very simple relationship. Ceteris paribus, all things remaining equal. It also has been a crappy hedge against inflation, because inflation, what we've got now, is supply-driven inflation, and it is really not what Bitcoin does. What Bitcoin does is debasement of currency. Same with gold. People got very confused with gold, and it's done terribly. The great 1970s inflation, it came back, and we're supposed to see gold go to the moon. It's the debasement of currency where gold goes to the moon. And for that, you need to see M2 growth, you need to see liquidity, you need to see central bank balance sheets rising. We're just not seeing that. We're seeing the opposite. So it's bad. It's a bad environment. So the dollar has an outsize versus its actual economic impact. So then when the Federal Reserve tinker around with the supply of money, and they've been reducing it, there's somebody out in the outer world who's like, shit, I can't get my dollars. I call it a game of musical chairs. And the first game of musical chairs was the chair got rug pulled on Sri Lanka. It's the weak borrowers who can't get the dollars. There's less dollars around, and there's so many needs for dollars, so much borrowing goes on, that what happens is everybody competitively bids the dollar higher. I need my dollars. And the people who can't fall by the wayside. They can't pay their debts. Also, the other reason, so the Federal Reserve is taking money out, but the US is also running less of a trade deficit. What is a trade deficit? A trade deficit is the US buying foreign goods with US dollars. those dollars go into the global system. So if they're buying less foreign goods or they're selling more of their own goods, what you're doing is taking dollars out. So you've got this perfect storm of dollars leaving the system and people needing them. And it creates this horrible dynamic of the dollar going higher over time. So as the dollar goes higher, generally speaking, assets denominated in dollars go lower. And so Bitcoin will go lower over time. Normally that would happen to things like the energy market, but the energy market's being driven by other supply and demand dynamics as well. So that is why it's very difficult for these global assets when it happens, because they tend to be depriced lower. It's a very deflationary force having a strong dollar. And I know we're living in an inflationary world, but we're setting up ourselves back up for a deflationary world by having a very strong dollar. Why is that? Well, look at the world's biggest exporting nations of finished goods. Japan, China, Europe, South Korea, Taiwan, all of their currencies have fallen massively. So they can sell goods cheaper to the US. So that's very good for the US because inflation falls. But difficult for those countries because inflation remains high. Complicated macro world out there. We're starting to see the potential turn, but the US is still firmly negative. And until the US cycle turns a bit, we're going to see some stabilization in this monetary cycle. But the probabilistic outcome is we have to live in the next 6 to 12 months forward, because that's where crypto lives. And crypto bottomed in June. And so what it's saying is the rate of change of liquidity is now somewhat improving. It's still negative. So I think crypto gave us the signal that things are changing at the margin, but it's too soon for it to fully drive prices. So I think I was just with an interview with Mark Yusko. He put it really nicely. He goes, crypto winter finished in June 14th and crypto spring started, and spring is muddy, some days cold, some days sunny, some days wet, some days windy. But what follows spring is summer, and we're still in spring. So the market goes up and down, doesn't really do a lot, doesn't feel good for anybody, neither bulls nor bears. And that is the function of the economic cycle starting to turn. It's really about how we live our lives on the internet. It's really a broader question about who owns the information. It's who owns identity. These are the big questions. This is what 6529 is talking about, the open metaverse. Who owns this new digital world where we live in digital communities and digital societies? What ownership of goods? And yes, we can talk about ownership of an NFT, as I've got on my token frame behind me, but really it's bigger than that. It's how do we transfer value and maintain identity in this new world? We were already seeing the rise of AI. And AI is terrifying in deep fakes. It's terrifying in what it can do and who it can be online. How do we know who's real and who's not? Well, identity is an urgent solve. It's an urgent solve because we're getting abused by the larger platforms, because they use our identity, package it up and sell it to advertisers. Why should that be the case? Why should we not participate in that economy? That's coming. But what becomes more powerful is when you can put things on the chain. And by putting a JPEG on a chain, you've created scarcity out of nothing, out of something that could be infinite. And digital scarcity therefore allows value to occur, because almost nothing in the world that is infinite has value. So by creating scarcity, that's the big unlock here. So scarcity and identity in this new digital world allows a massive change in global business models, including community Web3 driven stuff, but also how we operate in the metaverse and the digital world going forwards. I'm also interested in what is the next big thing that's coming at the protocol layer stuff. I mean, Ash has talked about the cross-chain stuff, which is very interesting. Yeah, Ethereum is always very interesting. What else is happening? You know, there's a lot of buzz around things like Aptos, and buzz still around Near, and buzz around one that's still coming, which is Sui. There's some interesting stuff out there. So it's really my eyes on the future and what the world is going to look like in 12 to 18 months time, and considering how many people are building things, how many people want to disrupt things, how many people kind of know the sorts of things that we've been talking about endlessly and are doing something about it, I think is going to lead to extraordinary outcomes of which we don't yet know. Different people who focus on different areas will notice these incredible breakthroughs that are happening in front of your eyes. It's hidden by the fact that the market's in crypto spring and you don't really feel it. But shit is going on at scale. But we're all taught one thing. It's a Pavlovian response, and we know what it is: more cowbell. And I wrote about this in GMI this weekend. It's basically the answer to everything is more cowbell, i.e. print more money. So as the bond market starts to become even more illiquid, it's bloody illiquid now. I think it's broken. It's broken away from the business cycle. It's broken away from inflation break-evens. It's completely not tracking anything. It's like on its own, unanchored, untethered. That's going to produce unintended consequences. Does the equity market need to break? Not necessarily. The bond market has broken. This is the worst performance in bond market history. This is the worst performance of 60-40 portfolios in history. What we're actually doing is breaking the baby boomers' pensions. And politicians don't like that stuff because guess what? They're all baby boomers and all their friends are baby boomers, and baby boomers are 76 million voters. The last thing they want is to upset those people. So they will eventually come to the rescue. Possible that you get one final sharp panic over the next 2 weeks, and I think that's the time horizon we're talking about, 2 to 3 weeks. But we kind of know the outcome. The expected future return explodes the closer you get to the authorities having to fix it. And the upside already, think of it in Solana terms, an easy way, because I was having this conversation last night. Solana's down 85% from the high. Its high was like 250 or 280, whatever the number was. It's at 33. So 10x just to get back to the high. And its network activity is still high. So the expected upside, if it does get adopted further and it continues to grow, the expected upside of these things are bananas now. Ethereum, it's the bananas expected upside. So really, whether you get it 30% cheaper in a sell-off or not is kind of irrelevant at this point.